IFRS 5 non-current asset held for sale and discontinued operation. Okay, so this accounting standard. So this accounting standard with respect to the conceptual framework is more about presentation. With respect to the conceptual framework, it's about presentation. And the presentation with respect to statement of financial position, some aspects, and some income statement. Income statement and SFP. So one by one. Number one, number two. So conceptual framework, that is presentation matter, and that is about some important area related to SFP presentation and income statement presentation. What accounting standard says? Accounting standards, as we already discussed in previous sessions, that our role as a professional accountant, that's the report, one of the important role with respect to a professional accountant, if we are responsible for the reporting, that the financial statement should be transparent and very much clear, easy to understand, not vague. So one of the accounting standards with respect to the presentations, that's IFRS 5. What IFRS 5 says that if any of the non-current asset with respect to IFRS 5, that means no deferred tax, no employee benefit, no financial asset, no investment property, no biological asset, no insurance contract. Other than this, for any non-current asset, for example, property, plant and equipment, the management has an intention that the future economic benefit, we will get, the future economic benefit we will get by in the near future by selling rather than using. So principally the management has intention to get the future economic benefit on the basis of sale, not or instead of use. So on that basis, if IFRS 5 two conditions meet, it's not about the intention base only. Two conditions meet. Number one, immediately available for sale. Immediately available for sale. Plus, sale is highly probable. If these two conditions meet with the intention of the company, that means IFRS 5 criteria has met, and we have to reclassify or represent, for the better presentation, represent the non-current asset as a non-current asset held for sale, in the current assets. Okay, and not only the presentation will be changed, the measurement will be lower of carrying amount as per IAS 16, that's previous calculated, or fair value less cost to sell. fair value less cost to sell. So actually this measurement is impairment test, but the impairment test of IFRS 5, that is comparatively different from IS 36, because if the lower value, for example, if lower value is 100, no adjustment required, no more adjustment related to IFRS 5, because it's lower off. But if in that case, if lower of this one, that means we need the adjustment of 10. That's the impairment loss. Means your current asset, means non-current asset should be transformed to fair value less cost to sell. Transform to the fair value less cost to sell. For example, based on this, we have purchased a plant 1st January 2015, plant for 100,000. Depreciation, straight line, and for example, its life is 10 years. Straight line depreciation for 6 years, let's suppose. That is 60,000. So carrying amount, that is 40,000. 10,000 per year depreciation. And 1st January, the plant cost, 15, 16, 17, 18, 19 and 20 has done. So our standing in at the year end 2020. In 2020, current year depreciation expense is 10,000. Current year depreciation expense is 10,000. We have already reported. But now the management has decided to sell this asset, although the life is not completed, but due to any reason the management has an intention to sell the asset by next year. And assessing these two conditions, is the asset immediately available for sale? So number one means immediately, means as is where is. If we are going to report the asset at 31st December 2020, so whatever the condition of the asset, whatever, plus or minus, management has decided to sell in same condition, without any renovation, without any adjustment, without any maintenance. Regular maintenance is something else, but without any renovation or anything. For example, if some subsidence found with the machine and management saying that we will adjust or rectify this subsidence or this issue, then we will the machine will be able to sell. No. At the point where you are reporting the IFRS 5, the position of the reporting at the position of the reporting, the asset should be available for sale immediately, as is where is basis, number one. So 2020 asset is immediately available for sale, and sale is highly probable. Sale is highly probable means Highly probable is a subjective matter, but the accounting standard with this statement. Supports with this statement. How comes the immediately available for sale? Oh, sorry. How comes the highly probable? That's we have to make a judgment that by 2020, within 1 year, the asset within 2021, the asset is will be sale. Management is searching or starting to locate a buyer. The price is reasonable. The management in near future has no intention to withdraw the plan. So these are all supportive conditions. These are all supportive conditions. That is Puma's price which the asset marked for sale must be reasonable in relation to its current fair value. Unlike the significant changes will be made to the plan, a plan withdrawn. Management must be committed to plan, active program to locate a buyer and complete the plan must have been initiated. Active location of the buyer. Sale expected to qualify for recognition completed within 1 year from the date of classification. If these conditions are met with the immediately available for sale, this one, the asset must be available for immediately sale in its present condition, subject only to usual and customary sales term. Immediately, normal conditions. So for example, conditions have met and we have an intention to reclassify the asset with this term, that is fair value less cost to sell. For example, the asset fair value less cost to sell is 35,000. So lower off is 35 and it's qualified for impairment loss. So what the transaction will actually be made. The transaction will be, although plant has a carrying amount of 40,000. So listen carefully. The transaction will be, number one, the non-current asset, property, plant and equipment should be de-recognized with the value of 40,000. And the recognized amount is non-current asset held for sale, and that is 35,000. And 5,000 should be the impairment loss. Impairment loss by IFRS 5. It will be mentioned with the value of 5,000. And total expense 15,000 and SFP, that is non-current. In the current asset, it will be shown non-current asset held for sale with the value of 35,000. I hope that all of you got this point and it should be very much crystal clear. It should be very much crystal clear. Okay, so that's done, huh? With respect to very initial aspect of the IFRS 5, which you have already done in the F7 aspects. But candidates, do remember one thing. This IFRS 5 non-current asset held for sale aspect, it's not only about individual non-current asset. It's not only about individual non-current assets. It's also about disposal group, candidates. It's also about disposal group. So what is this disposal group about? It's not individual asset. What is this disposal group about? Disposal group is something about a group of assets. A group of assets. That's the definition is mentioned here. The term disposal group. Yes, this one. Disposal group is a group of assets to be disposed of, sale or otherwise, together as a group in a single transaction, and liability associated with those assets that will be transferred in the transaction. That will be transferred in the transaction. The disposal group may be grouped as a cash generating unit, a single cash generating unit, or part of cash generating unit. Do remember one thing. Listen here. Disposal group means we are going to sell a group of assets in a single transaction with their associated liability. Number one, is the cash generating unit a disposal group? Yes, cash generating unit is a disposal group. But not only the cash generating unit is a disposal group. Not only the cash generating unit or the disposal group. Recall the cash generating unit. What are the cash generating unit? Cash generating unit is a group of assets that independently generate the cash flows. For example, you have a business of 3 restaurants, right? You have a business of the 3 restaurants, and you are going to sell 1 restaurant. Each restaurant generate the cash flow independently. So is the restaurant, each restaurant, a disposal group? Yes, because each restaurant, by the definition of disposal group, has an asset and associated liability. But the term disposal group not mentioning the independent term. Independent asset and associated liability is a part of cash generating unit. Now, one more example, which is a disposal group but not the cash generating unit. For example, you have one factory and having a different machineries, and you have, for example, 5 machineries, and you have 5 product lines. One factory, 5 machines, 5 product lines, and your complete one factory is a cash generating unit. Complete one factory is a cash generating unit because all the machines and products are interrelated. But all the products are making in different 5 machines. For example, A product, A machine, B product, B machine, C product, C machine, D product, D machine, E product, E machine. Now, the management has just decided to shut down the product E for any reason. Shut down or any reason. You have a plan to sell it. So that means that disposal group is not the cash generating unit, but a group of asset and associated liability. Means product related all the asset, including machine, including current assets as well, and its liability, either liability or current liability, non-current liability, current liability, all should be considered as a non-current asset held for sale. So I say to you that disposal group either cash generating unit or other than cash generating unit. But that means group of asset and associated liability. So if the disposal group apply for IFRS 5 non-current asset held for sale. So again, in case of disposal group, measurement, how to measure? The measurement is carrying amount, but carrying amount of not single assets. It's a complete group of asset and minus, sorry, carrying amount of total assets minus total liability versus fair value less cost to sell of a complete group, and the difference that is lower of lower off, and it may be the impairment loss. If the lower one is fair value less cost to sell, then impairment loss. And the associated transaction will be all the non-current assets should be closed, current assets should be closed, non-current liability should be closed, current liability should be closed. Two accounts will be created. Number one, non-current asset held for sale. Non-current asset, non-current asset held for sale, and current asset associated, sorry, current liability associated with disposal group, ASS associated with disposal group, and any of the difference, definitely difference, it's impairment loss. So this will be the measurement of the disposal group. Yes, it's important. It's important. It's very, very much important. Okay, so now what we have done initially, either individual asset or disposal group, either individual asset or disposal group. The management has an intention to get the future economic benefit from the sale instead of using it. And then IFRS 5 two conditions going to meet. Number one, immediately available for sale, and sale is highly probable with supportive judgmental conditions of the immediately available for sale. Then we must have to present with the measurement criteria of IFRS 5 as a non-current asset held for sale with the lower of carrying amount and fair value less cost to sell. This one. Now, furthermore, you have to clarify some more important thing, and I will continue the aspect. Okay, one more thing. Yes, one more thing. If the cash generating unit, yes, remember this thing. One more thing for the disposal group. If disposal group with respect to gas generating unit has some goodwill, then the treatment of impairment is same like IS 36. You remember? First, impairment should be adjusted. First, impairment should be adjusted with the goodwill. First, impairment should be adjusted with the goodwill, and then rest. And then the rest of the part allocate with pro rata basis to the others. With pro rata basis to the others. So that's all with respect to the disposal group. Now move on.